When buying a home in Ireland, there are two insurance policies that you must have: mortgage protection insurance and buildings insurance. You will not be able to get a mortgage from the bank without these insurance policies. Mortgage lenders are legally required to ensure that a borrower has mortgage protection insurance in place before granting a loan. While buildings insurance isn't required by law, most, if not all, banks will require mortgage holders to have it in place. Why? Because the property is the bank's collateral in the event of a mortgage holder's default, and the bank will want its collateral to be insured. Despite the fact that nearly every homeowner in the country will have interactions with both mortgage protection insurance and buildings insurance, there seems to be a lot of confusion around what they actually are. So the goal of this video is to clear up that confusion by explaining both of these insurance policies in plain English. Let's kick things off with mortgage protection insurance. Mortgage protection insurance is a life assurance policy which pays out a sum of money when the individual who is insured by the policy dies. Mortgage protection insurance is a form of temporary life assurance, given that it only provides cover for a specified period of time, which is known as the policy term. In this case, the policy term will be the same as the anticipated mortgage term, which can be up to 35 years in length. The idea behind mortgage protection insurance is that if the borrower dies during the mortgage term, then a sum of money will be paid out by the life assurance company so that the bank is repaid and the borrower's dependents will own the property in full. As the borrower pays off their mortgage over the course of the mortgage term, the amount of cover that's provided by the borrower's mortgage protection policy will decline. Mortgage protection policies are interest rate sensitive. Reason being, for variable rate mortgages, the policy will need to estimate a certain mortgage interest rate that will persist over the life of the mortgage. It's not possible to predict with 100% certainty what interest rates will look like in the future. Provided that interest rates do not increase above the estimation, then the level of cover should always be sufficient to pay off the mortgage upon death. However, the opposite is also true, and so there's a risk that the mortgage protection cover may not be sufficient to pay off the mortgage outstanding upon death due to mortgage interest rates being higher than anticipated. The higher the estimation for mortgage interest rates at the outset, the higher the policy premium will be, as more cover is being provided over the policy term. If it turns out that actual mortgage interest rates are lower than the estimation, then upon death, any surplus cover will be transferred to the deceased individual's estate. While lenders are legally required to have the ability to arrange mortgage protection insurance for the borrower, they are not required to facilitate cover in the following circumstances: A, where the property is not intended to be used as the principal private residence of the borrower or his or her dependents; B, where the borrower is not insurable or is only insurable for a significantly high premium; C, where the borrower is over 50 years of age; and D, where the borrower already has mortgage protection for an amount not less than the loan outstanding. A borrower can choose to arrange their own mortgage protection insurance if they so choose, and there are some notable advantages of doing so. First and foremost, the borrower won't be restricted to the life assurance company that is utilized by the lender for mortgage protection. This means that the borrower can shop around for the best coverage at the best price. Secondly, if the borrower decides to move his or her mortgage from one lender to another, then he or she can bring the mortgage protection policy to the new lender for the new loan. And finally, the borrower can potentially access a greater choice of optional benefits by sourcing their own mortgage protection. One such optional benefit is specified illness cover. Certain mortgage protection policies may offer specified illness cover, whereby the sum insured will be paid out at an earlier date than the date of death, where the borrower contracts or suffers from one of the specified serious illnesses covered by the policy. While adding specified illness cover would increase the cost of the insurance premium, it would also provide the borrower with comfort in knowing that they'd be free from the financial burden of a mortgage if they were ever to be diagnosed with one of the covered illnesses. Another valuable optional benefit that you can add onto your mortgage protection insurance is a conversion option. With a conversion option, you can convert your mortgage protection insurance policy into a new policy, irrespective of the health status of the insured individual at the time that the conversion option is exercised. One of the risks of temporary assurance policies is that the insured individual may not be able to get replacement cover when it's needed at a premium that they can afford if their health has deteriorated in the intervening period. In other words, if you were to ever need to amend your cover in the future without a conversion option, option, you need to redo your medical questionnaire again, which may lead to a higher insurance premium. When you add a conversion option, you can extend your policy term, convert your decreasing term policy to a level term policy, and even increase the amount of cover using a life events option or guaranteed insurability option. Again, this is achieved without needing to redo your medical questionnaire, which could save you a lot of money. That's not to say that your new premium upon conversion will remain the same. The life insurance company will account for other factors outside of your medical history, like your age, the level of cover required, and the going rates at that time in order to calculate your new insurance premium. The extra cost of adding a conversion option to your mortgage protection policy is typically 5 to 10% of the insurance premium. Then we have buildings insurance. As we mentioned at the beginning, lenders will want the main structure of the home and any outbuildings to be insured in respect of damage caused by fire, theft, subsidence, water damage, and any damage caused by objects falling onto the property, such as tree branches. Again, this can be arranged either directly via the lender or independently. Where a claim is made under a buildings insurance policy, the sum of money will be issued in the joint names of both the borrower and the lender. Reason being, the lender needs to be sure that the borrower will use the money appropriately, i.e. carrying out the necessary repairs, otherwise the bank will be left with a less valuable property acting as collateral for the money that they're owed. The property must be insured for a sum equal to the cost of rebuilding the property from scratch. This is known as the reinstatement value, which is not the same as the market value of the property. The property's market value will typically be higher, given that the site which the property is built on will continue to persist even if the property is destroyed. For apartments, the situation is slightly different. All of the individual apartment owners combine to form a management company or MANCO, and the MANCO insures the entire apartment block for its reinstatement value. Each individual apartment owner is then assigned their relative share of the insurance cost. It's really important to be aware of the risk of underinsurance. Naturally, the reinstatement value of your property will increase over time due to inflation. If your insurance cover isn't also increasing over time, then should a future claim come to fruition, you'll find yourself underinsured, and there is a real cost associated with this. Insurance companies use what are known as average clauses to reduce the amount that they have to pay out where a claim is made and the property is underinsured. Logically, this makes sense. If a policyholder doesn't fully insure their property and consequently pays a lower premium, then the insurer can't be expected to pay out 100% of the incurred loss. Rather, the payout will be limited to the proportion of the reinstatement value that is insured. This is calculated as the sum insured divided by the reinstatement value and multiplied by the loss incurred. So underinsurance is not a tactical play, but instead is a surefire way to incur financial loss upon the happening of an insured event. That begs the question, how can underinsurance be avoided? Some insurers may operate an indexation system whereby the sums insured are automatically increased annually in line with various indices which track construction costs. Insurance premiums would also scale in line with the increase in cover. However, even if indexation is applied by the insurer, there's no guarantee that it will fully protect the insured individual against underinsurance. That's because the reinstatement value of the individual's property could be growing at a faster rate than the rate of general construction costs. For that reason, you should ensure that you're checking the insured sum on a regular basis in order to assess whether it's adequate to cover the full reinstatement value of the property. When making a claim on buildings insurance, the burden of proof lies with the insured individual to show A, that an insured event occurred, and B, the value of the loss arising from that event. When a claim is denied, then the burden of proof flips to the insurer. If the borrower is engaging in a self-build whereby the construction work is subcontracted out to various tradespeople, then different insurance policies will apply. Firstly, in order for the funds to be released from the bank, the construction of the property must be supervised by a qualified architect, engineer, or surveyor who has their own indemnity insurance, which can be called upon should a defect be discovered after the property has been constructed. For self-builds, the bank will offer a stage payment loan whereby the funds will be released in stages as the property construction progresses. The borrower must also take out insurance called Own Home Under Construction or Property in the Course of Construction Insurance for public liability and damages. This insurance is more commonly referred to as self-build insurance. Finally, for newly built properties, builders are required required to register with a scheme for structural defect cover, which protects the property against defects. Banks will typically request that the borrower provides evidence of this cover, which is obtained from the builder, when applying for a mortgage to purchase a newly built property. So that's 2 insurance policies that you must have when buying a home in Ireland: mortgage protection insurance and buildings insurance. We also covered the insurances that are required for self-build projects. While these are the insurance policies that are mandatory, they're not necessarily the only policies which are needed when buying a home. Contents insurance, for example, which alongside buildings insurance falls under the umbrella of general home insurance, can be useful for protecting the valuables that are contained within your home. Income protection, on the other hand, provides the insured individual with a regular income stream should they find themselves in a position where they're unable to work due to sickness or injury. This can be advisable where the household is heavily reliant on earned income for meeting ongoing financial commitments such as mortgage repayments, which don't stop if you happen to get sick or injured. If you have any questions on any of the material that was covered in this video, please don't hesitate to leave it as a comment down below and I'll answer it. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like in the video, subscribing to the channel, and sharing the video with family and friends. Before you go, you might be interested in this next video, which talks about the best savings accounts in Ireland in 2023. Thanks very much for watching, and I'll see you soon.